Look, if you've been following the financial news at all lately, you know one story has been absolutely dominating the headlines. The incredible, almost unbelievable surge in the price of gold. Seriously, it's a rally that has caught even the most seasoned experts completely off guard. So, get this. In early 2026, gold didn't just inch past a new record. It smashed through the $5,000 barrier, hitting an all-time high of over $5,100 an ounce. To give you some perspective on how wild that is, in 2025 alone, it set 53 new all-time highs. This isn't just a little jump, it's a massive seismic shift in the market. So the big question on everyone's mind is why? Why now? What on earth is creating this new gold rush? And, most importantly, what does this all mean for you and your money? Let's get into it. All right, here's the game plan for this explainer. We're going to unpack this crazy rally, and then we'll dig into what actually drives the price of gold. We'll take a quick trip back in time to put it all in context, then we'll zoom in on what's happening in the unique Indian market. After that, we'll look at your investment options for 2026 and wrap it all up with how to think about gold's place in your portfolio. Okay, first up, let's try to understand this historic rally. You have to realize this wasn't caused by just one thing. Nope. What we saw between 2024 and 2026 was more like a perfect storm, a bunch of really powerful factors all hitting at the exact same time. I mean, the sheer scale of this is just staggering. In 2025, gold shot up 67% in a single year. That's its best performance since way back in 1979. And this incredible surge was really powered by two main engines: central banks buying gold at a record-breaking pace and, well, a whole lot of geopolitical chaos around the world. So, to really get why this rally happened, we have to pop the hood and look at the core mechanics that actually drive the price of gold. So, what are these fundamental forces at play? The easiest way to think about it is like a seesaw. On one side, you have things that push the price up. Stuff like rising inflation, a weaker US dollar, falling interest rates, and any kind of economic crisis. On the other side, things that push it down. A strong dollar, rising rates, a booming stock market, and general stability. Well, for the last few years, the side pushing the price up has had all the weight.
And here is that perfect storm in detail. You had central banks, especially China, just going on a historic buying spree. They snapped up over 860 tons of gold in 2025 alone, trying to move away from the US dollar. At the exact same time, you have global conflicts flaring up, nagging fears about inflation, a weaker dollar because of Fed rate cuts, and then a flood of everyday investors piling into gold ETFs. All of that combined to launch the price into the stratosphere.
Now, as dramatic as all this feels, believe it or not, we've kind of seen this movie before. To understand where we might be going, it really helps to see where we've been. Gold's journey over the last 100 years or so shows a pretty clear pattern.
For decades, the price was basically fixed, but then, boom, 1971, the gold standard ends. Crisis hits. The oil crisis, crazy inflation, and the price just explodes by 2,300%. Then, for about 20 years, things calmed down and the price fell. But since 2001, we've been in this modern bull market with these massive spikes during the 2008 financial crisis, the 2020 pandemic, and of course, the turmoil we're seeing today. The pattern is crystal clear. Crisis is like rocket fuel for gold's price.
And this pattern of investors looking for safety is playing out in really fascinating ways around the world. Let's zoom in on India for a second, the world's #2 gold consumer. What's happening there is basically a tale of two very different demands. So on one hand, you have investment demand just absolutely exploding. In January 2026 alone, a record-breaking 240 billion rupees flowed into Indian gold ETFs. That is a massive shift, and it tells us that people are buying gold not just as jewelry anymore, but as a serious financial asset.
But here's the other side of the story. While investment demand was surging, the traditional demand for jewelry actually plummeted by 24% in 2025. Why? Well, the prices are just too high for a lot of people buying for weddings and festivals. So here's the key takeaway. In India, the investor is starting to replace the traditional consumer as the main driver of gold demand. Okay, so that brings us to you. Given this whole new landscape, if you're thinking about getting in, how can you actually participate? Let's break down the main ways you can invest in gold in India right now. You've basically got three main choices. First, there's physical gold. Coins and bars. The pro is that you can hold it.
The cons? You've got making charges, which are extra fees for crafting it, and you have to worry about storing it safely. It's probably best for things like gifting. Second, you have gold ETFs. Think of these like a stock that just tracks the price of gold. They're low cost, easy to buy and sell, but you do need a DMAT or an electronic account. These are great for regular investors, especially if you want to do an SIP and just put in a little every month. And finally, there are sovereign gold bonds, or SGBs. These are really interesting. They actually pay you 2.5% interest every year. And if you hold them for the full 8 years, any money you make is completely tax-free. That makes them perfect for long-term investors.
So the million-dollar question, or I guess the $5,000 question is, where does the price go from here? Well, as you can see, the experts are all over the place. The general agreement for 2026 is somewhere in this huge range, from $4,500 all the way up to $6,200. The most bullish is UBS, targeting $6,200, betting that all this geopolitical risk will keep pushing investors into gold. Then you have firms like JP Morgan and Goldman Sachs who think it'll stay above $5,000, mostly because of central bank buying. This just gives you a sense of the different ways this could play out.
Which brings us to probably the most important part of this whole explainer. What's the big takeaway here? How should you be thinking about gold's role in your portfolio, especially after a run-up like this?
Okay, if you remember one thing, please make it this. Gold is not a get-rich-quick scheme. It is financial insurance. Its real job in your portfolio is to preserve your wealth over the long haul, to give you diversification away from stocks and bonds, and to protect you when a crisis hits. Think of it as a defensive player, not a star striker.
So a smart gold strategy follows a few pretty simple rules. First, you have to think long-term. We're talking 5 to 10 years minimum. Second, and this is so important right now, do not chase the rally. The really big, fast gains have probably already happened. A better approach is to use any price drops or corrections to build up your position over time, and then just rebalance once a year to make sure you're on target, and be aware of the tax rules, especially those benefits you get with SGBs.
And how much is the right amount? Well, the standard, time-tested advice from most financial planners is to allocate somewhere between 10 and 15% of your total investment portfolio to gold. That's your insurance policy. Not much more, not much less.
So as we wrap this up, I want to leave you with this final thought. In a world that just seems to be getting more and more uncertain, the debate really isn't about if you should own gold anymore. The real question for a smart investor in 2026 is a strategic one. How much should you own, and what's the right way for you to own it?